So in part 2 of chapter 7, we're going to discuss, at least start talking about some theory. We're going to talk about essentially pricing and how we think that actually occurs, how it's impacted, how it changes. And then we'll ultimately move into the valuation part of the chapter. So let's go ahead and move on. Obviously, common stockholders want increasing stock prices, and they also want to receive some dividends. Some want more of one than the other, right? So some of these investors have to decide, right, which ones to buy, which ones to sell. This really is a subtopic, if you will, of an investments course. But in the end, if people are thinking about buying stocks, they want to try to find stocks that are going to increase in value, that are going to increase their wealth for whatever purpose they may need, for retirement, to purchase other assets, etc. So the search is for assets that are undervalued. So the topic and how we address this concept of undervalued assets, we have to talk about a theory that's called market efficiency. And market efficiency essentially tells us that the prices that we see are fair. So economically rational buyers and sellers are going to look at risk and return to determine value. In a competitive market where there's lots of people doing that assessment, it's very likely that the price you see is going to adequately reflect all the information that's available. And that concept, again, is referred to as market efficiency. Prices include information that's available. The theory itself is referred to as the efficient market hypothesis. In a perfect market, remember we don't live in one of those, securities are in equilibrium. There's no real need for them to move right or left, up or down. Prices reflect all information available, and they react quickly when new information is provided. And since prices include all of this information, we really shouldn't waste our time trying to find mispriced securities. So before we kind of go on, let's kind of think that through. It says, look, we should be doing this chapter. We shouldn't do this chapter because if the markets are efficient, you cannot find stocks that are incorrectly priced. Well, that is the question. That is the research question. Number one, is information in prices? Most information agrees, or most research agrees, that information gets into prices very in the correct way. But the second question is, how quickly does it get there? And that's where the research starts to fall apart. Depends on the kind of information. It depends on the kind of security it is. But in general, we like to think that stocks are fairly well priced, that they are efficiently priced. There is a growing body of research that kind of talks about why markets might not be efficient, right? And that really puts more of the impact of pricing on investors rather than information. So there's a whole thing. It's called behavioral finance. It is a mixture of psychology and finance to try to understand why do investors do the things they do. So there's lots of theories of the way people react. Regret theory says, again, we're not looking at valuation. We're just saying that, look, that people, it's an emotional reaction that people experience when they realize that they've made an error, right? So what they may do, what should they change? Should they sell? sometimes it makes it, they freeze and they don't change because they have this regret. Maybe they rationalize their decisions. They say, well, everybody else is buying that stock. I should buy that stock as well. The anchoring, right? Anchoring is a tendency to place more information on recent, more value on recent information than historical information. You hear something today and that must be it, so you react on it immediately without putting together the whole piece of pie. So again, this is a combination. It's a new venture, if you will, in the finance theory world that tries to explain why people do the things that they do. So let's kind of move on to the valuation piece. How can we find the value of a stock? The value of a common share of stock is the present value of all of its future cash flows. That is its dividends. So we have a formula here for all the dividends of a company from now to infinity. Very difficult formula to understand and deal with, but this formula actually algebraically converts to another formula. It simplifies. This formula here, which is the present value of all future dividends to infinity, is algebraically equivalent to this formula, which says that the value of a stock equals next year's dividend divided by the required return on the stock and the growth rate of future dividends. Well, how do you know what next year's dividend is? Well, we have a formula up here. It says D sub 0, if you know today's dividend, multiply it by 1 plus the future growth of dividends. Now, we're going to assume a constant growth model. So whatever G is, that's what we assume G is going to be to infinity. Now, obviously from that, you realize that there are some holes in the formula. It doesn't strictly hold, not only mathematically doesn't strictly hold, but it doesn't even necessarily hold for every kind of stock that you can think of. But we now have a very simplified formula to calculate and find the value of a stock. So here we have a stock. We estimate that the dividend is going to remain at $3 indefinitely. So the required rate of return of the stock is 15%. There is a stock valuation spreadsheet where you can plug in the information we know. What is the most recent dividend? It's $3, as was given in the problem. What is the growth rate of dividends? Well, it's going to remain constant. So the growth rate is 0. And the required return given is 15%. So the value of this stock is $20. So let's go back to our investment rules. If you paid $20, or would you pay $20 for this stock if it was available? Well, you go to the broker and the broker says you could buy this stock for $19. Would you pay $19 to get $20? Certainly you would. What about the required returns? All you want is 15%, but if you paid $19, you'd earn 15.8%. So this particular investment in a stock is a good investment. Another example, we have a preferred stock. It's going to sound very familiar. Pays a dividend of $6. Required returns 12%. So what's the growth rate? Again, preferred stocks have fixed dividends. So the dividend has a constant growth of 0%. $6 is the dividend this year. 12% is the required return. So the stock value, this stock's worth $50. If you could buy this stock for $59, would you? Would you pay $59 to get $50? Of course you wouldn't. But if you did, you wanted 12%, you'd only get 10%. So obviously this preferred stock is an example of a stock that is a bad investment. You don't get what you want out of this particular security. Let's move on and talk about common stocks now. $2.65 is the most recent dividend. They have been growing historically at 5%. So you need to put the 5% here in with G for the growth rate. Required return given to us is 20%. So the stock is worth $18.55. You can buy the stock for $15. Would you pay $15 to get $18? Of course you would. And if you did, you wanted 20%, you'd actually get 23%. This is obviously a good investment. Let's talk about some of the variables. How do you find the growth rate of dividends? Well, here we have this particular company. They give us dividends from 2010 to 2015. In the spreadsheet, we have a graph where you can input the data. The most recent dividend was $1.40. The first dividend that you're given is $1. And we need to know N. What's the years? 2015 minus 2010 is 5 years. So the growth rate on this Lamar stock is 6.96%. So we'll use that in our table here in a minute. We could also use the security market line, right? We'll talk about this when we get to the risk chapter, but in here there's a place where you can calculate K sub S or R sub S like it is in your textbook. But we need some information. The 30-year Treasury bond is yielding 4.75%. We're going to say that the stock market averages 12% and that this stock has a beta of 1.45. So what return would you want from this stock given its risk of 1.45 a beta? You would want 15.26% is the required return. So now let's put this into our format. We know that here's the dividend information we put in. Here's the required return information. We then just transfer these numbers up here. So this stock currently has a value of $18.04. If the stock price, if the stock price was $17.50, would you pay for it or would you buy it? Would you pay $17.50 to get 18? Absolutely. If you did that, you wanted 15.2, but you're going to get 15.5. So this is an example of how we can utilize some very easy to get data to estimate the value of a company's stock. But there are other companies that are a little bit harder to analyze. There are certain companies that don't have what we refer to as a constant growth dividend. They have changes or spurts in dividends. These typically are going to be more innovation kinds of companies. So in this case, this company invented a brand new toothpaste that doesn't require a toothbrush, right? So we can create that's going to have an increase in earnings for a very short time until corporate saboteurs steal the process, right? So for the next 3 years, it's going to grow at 15%, and then eventually it'll go back to the industry average of 8%. The most current dividend is $2. The required return for the stock is 12%, and its current stock has been selling for $61.75. So we have a valuation spreadsheet called time value supernormal stock valuation, and we can plug in our data. $2 is the dividend, 8% growth, 15% supernormal. It's going to grow supernormal for 3. 12% is the required return. Current stock's at $61.75. So when you plug that data in at the bottom here, it tells us that the value of this stock is $64.78. Current stock price is $61.75. And of course, you would pay $61 to get $64. Again, this is a stock, or this is the kind of a company that doesn't have, or we don't even expect it to have, a constant growth of dividends. What about a company that doesn't pay dividends? This dividend valuation models, neither one of them is going to work. What if the growth rate that we're talking about of dividends is greater than the required return for the company? Again, we won't get an answer. And finally, what if it just doesn't have stock? What if this is a sole proprietorship or a partnership? Or what if it's a company's corporation that the stock doesn't publicly trade? How can we find the value of those kinds of companies? We have a formula, a process called the free cash flow valuation model. In this case, if you look, the formula is very similar, right? In the numerator, instead of D sub 1, we have free cash flow 1. So we need to forecast the free cash flow of the company 1 year out. How do we do that? Well, we know what the current cash flow is. We need to find the growth rate in free cash flow, and that's what the G is in this formula. Now, R sub A is a little bit different than R sub S. R sub S is the required rate of return on the stock. R sub A is what's referred to as the weighted average cost of capital. It's the cost of financing the company. So in this case, especially if you think about a sole proprietor, since you don't have stock, how are you going to find the money to buy this company? Well, you're probably going to borrow a lot of it. So the cost of financing for a sole proprietorship is usually going to be debt. It's going to be borrowed money. So we can, again, adapt this for companies that are not publicly traded corporations. So again, what this tells us, though, it gives us the value of the entire company. What we want to know is, what is the value of the equity? What's the value of the common stock of the company? So we need to do a formula here. The stock of the company equals the value of the company, V sub C, minus the value of the debt and the value of any preferred stock if it has some. So again, we can calculate this. Now, it's not going to give us a per share price. It's going to give us a value that the ownership is worth. So here we have this company. We have some free cash flow numbers. 2009 was 400,000. 2013 was 600,000. We have its weighted average cost of capital. We'll actually calculate that in a chapter later on. The future growth of the company, the free cash flow is 3%. And we have information about debt, cash, and the outstanding shares of the company. So now we can plug this. We have free cash flow valuation model. It's on the spreadsheet. When you plug that information in here, again, the information in general is very similar to that of the constant growth dividends, right? Here we have the cost of financing, 9%, the growth rate of free cash flow. The forecasted free cash flow next year is $618,000. So the value of this corporation is $10.3 million. But now what we have to do is incorporate some other information. What is the market value of debt? Is $3.5 million. The cash that's available is $750,000. So the market value of common stock is $7.55 million. If we wanted to find a per share price, say this is a non-publicly traded stock that has 300,000 shares, then we could divide that out. We would find out that approximately you're paying $25 a share to purchase the shares of this stock. So again, this is a model that works for companies that don't pay dividends. But there are some other valuation models. The book value per share looks at the accounting equation. What is the ultimate book value of equity? So you take the total assets of the company, subtract the total liabilities, that leaves you with common equity. Divide that by the number of shares, and you have book value per share. Now the problem with this is its reliance on historical data. The older the company, the older the assets, the more likely this is not reflective of the company's true value. The liquidation value is an attempt to fix that. So now we're going to look at market values. What's the market value of total assets minus the market value of the debt? That leaves us with what should be the common equity value of the company divide that by the number of shares, and you have liquidation value per share. The challenge here is, even though we're using more realistic numbers, there are still assets that don't have prices, right? All the assets are not on the books of the company, right? And quite frankly, I mean, how do you put a price tag on a patent or a trademark? So, again, we still have some challenges with this liquidation value, but it's better than the book value per share. Another approach that's frequently used because it's so simple to use is something called the PE, or the price earnings multiple approach. The PE ratio, if you remember from the ratio chapter, is market price divided by earnings per share. What we're going to do now, though, is we're going to use some forecast. What is, if you see here, this is earnings per share T plus 1. So it's whatever the earnings per share is today, but forecasted 1 year out. What is the industry average for the PE of your company, the industry that's in? Frequently we can find those, but we can also possibly find a forecasted PE ratio 1 year out. It's called a forward PE ratio. So again, if we can find that information, we expect to get $2.60 per share in earnings next year. The industry average that Lamar is in has a ratio of 7. So that company should have a ballpark price of around $18.20. Again, we need to compare that to value so that we can ultimately determine what is this stock actually worth. Now, most companies, most financial analysts are going to use many approaches. They're maybe going to have 10 or 15 other ways to find value to ultimately come up with some prediction of what they think the company is worth. The challenge that we have with the PE ratio is that number one is it's driven by people, right? They vary widely from time to time, right? But I think personally that the biggest challenge is it is individuals who drive the PE ratio, right? It's the market price divided by earnings per share. So it should give us a decent estimate of what the short range prices are, but it probably will not give us a very good idea of what long-term holding prices should be. So ultimately, how does this work, right? I want to make a decision. The company, the managers of a company want to make a decision, and we need to understand, well, how is it going to affect return, right? How's it going to affect the dividends of the company? How's it going to affect the growth rate moving forward of the dividend stream? And quite frankly, the second part then is, how does this all fit into the overall risk of the company? How does it change the required return that investors are going to want to purchase the stock of the company? Again, lots of things change. Economic conditions change. So if we make some decisions that will increase dividends but don't change risk, what should ultimately happen? Well, if we think dividends are going to go up, risk doesn't change, that probably is going to, owners are going to think that is good, and they may increase their demand for the stock, which ultimately then will increase the price of the stock. Here's an example, right? So we're going to have the dividend is at $1.50. The expected growth rate is going to increase from 7 to 9%. So if the dividend goes up, if the growth rate of dividend goes up, what ultimately happens to the value of the stock? The value of the stock increases. What about changes in risk? We have this component. We had this formula earlier, that the risk-free rate plus the risk premium is the nominal rate of return. So now we're talking about a stock. So what things affect risk? The real rate affects risk. That's an economic number. Inflation affects risk. That is driven by not just the economy, it also by the decisions that management makes and their sensitivity to inflation. but also it has an impact on risk. So if the required return goes up, that's going to have an impact on the value of the company. In fact, if the risk goes up, and if that was going to cause the required returns of investors to go up, the value of the stock is ultimately going to increase. So what should managers want to do? They should try to drive dividends up as much as they possibly can, but they should also attempt to have a positive impact on the growth rate of future dividends, but they also should try to reduce the required rate of return on the stock. So again, here we have, we changed the required return, went to 16%. So now you can see obviously that the value of the stock now went from $25 odd down to $16 because risk went up. And of course we can put a combined effect, right? The dividend went up, risk went up. What happens obviously to the value? In this case, we ended up with a $21.43 is the value of this company's stock. Now that's pretty quick. There's a lot of things going on in valuation. We'll do some problems and discussion in class. Hopefully we can make this a little bit more clear. As a disclaimer though, do not apply any of these models to your own investments. We are taking many shortcuts. We haven't discussed how you determine what the G is. How do you actually determine what you think the required return is? There's many techniques, many models that can be used to try to address those two variables, and we've only talked about one for each. So there's a lot of things that are missing from this analysis.